This is level 2 of the CFA program, the topic on equity valuation and the reading on private company valuation. In previous recordings, you might remember that I've used fictional, made-up companies to provide you with some examples like Jim's Bakery and Jim's Motorcycle Company and Jim's Golf Club Manufacturing Company. What I'm going to do in this slide deck is I'm going to not only date myself, but I'm going to give you a real-life fictional example. When I was in high school and college, I used to watch a show called Dallas with my mother. And Dallas was a show that described this Ewing Oil company, which was owned by 10 or 12 different family members. And there was mayhem, and there was all sorts of adult themes, but there was treachery. But the bottom line of the show was that the two brothers who owned the company, J.R. Ewing and Bobby Ewing, they fought over so many things, but they were very interested in maximizing shareholder wealth. Now, both of them went about this in completely different ways. But as you see, we go through this slide deck here. This is a really good example of a private company that played an important role in my formation. Look at these learning outcome statements here. Compare public and private company valuation. That could be considered perhaps the most, or at least the leading LOS in this reading, because it explains to us the difference between what we've pretty much been doing over these last multiple slide decks and readings, and then let's take a look at valuing a private company, which we're going to use a lot of the same things that we did. Look at some of these: income, market, and asset-based approaches, cash flow estimation, free cash flow. Look at the bottom there: capital asset pricing model, and asset-based approach. And of course, we're going to have to worry about things with the private company that sound like liquidity issues and marketability issues. And so the ultimate question that we're trying to answer here as good financial analysts is, all right, if we can go value a company that trades on the floor of the New York Stock Exchange, we have one way to do that. But then how do we value a company that does not have public ownership and does not trade on an exchange? Now, we're going to have to probably put our working gloves on and get our shovels out and work a little bit harder, because this information is not going to be as readily available. Let's go and jump right into that first LOS. Compare public and private company valuation. Look over in the right-hand column, public companies. We know all of that stuff. This is what we've been talking about for months and months. Private companies are exactly almost the opposite. They don't have to be in every bullet point, but they are almost exactly the opposite of public companies. They tend to be less mature. Ewing Oil was probably only a decade old when the television show started. Of course, Ewing Oil was competing. Now remember, this is 1980, so who was around back then? You know, Mobil and Exxon, they were two separate companies. British Petroleum, Shell. You know, there were these huge mammoth international companies that Ewing Oil was competing against. So there you go, smaller in size, which must mean there's a higher risk premium. Managers hold substantial ownership. I mean, that's true. Bobby Ewing and J.R. Ewing, they ran the company, and I think they controlled, I don't know, 60 or 70% of the ownership. Lower quality of information. I just said that a few moments ago. Shareholders have a longer term perspective, and that's interesting comparison. If you look over on the right under public companies, more focused on short-term performance. I always shudder when I hear that about public companies, because as you remember, Modigliani and Miller taught us that the goal of the business is to maximize value over the long term as the firm operates as a going concern. And then this last one here is really interesting: greater focus on tax management. And that's because, you know, these owners, they want to minimize their tax liability because it affects their personal wealths, or as opposed to the public companies over here, where you have managers and executive and board members who own just a small part of the company. So less focus on tax management over there on public companies. Don't think that means, you know, no focus or a minor focus. I mean, of course, public companies are intensely focused on that, but not nearly as much as the private companies. Yeah, I'm guessing I don't really need to tell you much about this slide deck, right? Shares are less liquid in private companies. Yeah, J.R. Ewing and Bobby Ewing, they were very protective of their ownership. Remember I said there were about 10 or 12 family members, and whenever one of those family members, was disgusted with their leadership, primarily J.R.'s leadership, they would say, "Oh, we want out." And he would say, "Oh yeah, I'll buy your shares." And then everybody else would say, "No, don't sell to J.R. Then he'll have total control." So they're less liquid. Sometimes in these private companies, they're almost completely illiquid. Concentration of share ownership and control, that makes sense. And then potential restrictions on the sale of shares, that's what I was just describing. Now this slide right here kind of summarizes the 8 or 10 seasons of the show Dallas. We almost hit every one of these during those 8 or 10 seasons. Private financing, J.R. Ewing and Bobby Ewing, they were always going to the bank to try to borrow money, and they were, of course, used the oil wells as collateral. And I'm certain, although I can't remember a specific example, that they both used the same oil well as collateral for, a personal loan. I think that's called rehypothecation. I'm sure that was illegal during the show. Initial public offerings, Ewing Oil never went through one of those things. But of course, this is super important for us as financial analysts. If we have a private company who, of course, is growing and growing, and what does that mean? That means that they've asked all their family members for capital, and they've hit their limit with bank loans, and so they want to raise capital through issuance of shares to shareholders all over the world. So that's a super important one. Acquisitions, Ewing Oil used to buy up firms, small oil wells every year, all the time. So that's an important role. Bankruptcy, you probably don't remember this, but in the early 1980s, the price of a barrel of oil was, I don't know, $10 or $12 a barrel, maybe even $8 a barrel. And Ewing Oil was the threat of going into bankruptcy because oil prices were so low. So JR concocted a scheme to raise oil prices. He almost went to jail for that one. Share-based compensation, that makes sense then. So then what does that mean over here for specific transactions? I mean, we need to do financial reporting and we need to do tax reporting. And then, of course, there's some legalities associated with all of this other stuff over on the left-hand side. Damage claims, lost profit claims, shareholder disputes. I mean, this happened in Ewing Oil all the time. The 10 or 12 family members were always fighting. And then divorce settlements. Sue Ellen Ewing and J.R. Ewing, they divorced, and she said, "J.R., I want half of your ownership." And of course, he was saying, there's no way that's going to happen. And so they had to value his portion of Ewing Oil. How about this LOS? Let's go ahead and try to figure out how to value a company. What are we going to do? Well, income approach, market approach, and asset-based approach. If you don't read any of those arrow points before I get to them, you should be thinking along the following lines. You should be thinking, oh, wait a minute, Jim, didn't we just do this with free cash flow reading, with the dividend policy reading, and with the residual income reading? And yes, and that's why this reading comes after those three. But what we're going to do is take a combination of what we have done before and those three readings and form a value based on income, market, and asset-based approach. So look at some of these concepts here. Present value of expected future cash flows, nothing new there. Enterprise value multiples, sales of similar assets, nothing new there. And an asset-based approach, nothing really new there, but remember, this asset-based approach is going to become relevant because we're not quite sure if we can totally trust what goes on in the income statement, but we know we can trust what's on the balance sheet because we can see how much things cost, right? Assets, liabilities, and equity. And so that asset-based approach is really the fundamental accounting equation. Assets is equal to liabilities plus equity, so you can rearrange that formula to come up with the value of equity. A couple of really potential exam questions here. Notice the third arrow point under each block: absolute for income, absolute for asset-based, but relative for market-based. I'm sure we talked about that before in previous readings, but that sounds like a good potential exam question to me. Of course, what else do we need to consider? Nature of the operations, size of the company, and stage of the life cycle. That should make perfect sense. All right, let's get back to this concept of normalized earnings that was introduced a reading or two ago. Remember, look at that left circle point, reported earnings. That's the reported earnings that we can find on, now if this is a publicly held company, we can find these on Yahoo Finance pretty quickly. If these are reported earnings, we may have to do some digging, and we may have to do some asking, and we may have to do some other research to get reported earnings. And then what we're going to do is make some adjustments. And we need to adjust these for things like non-recurring items, maybe unusual items, maybe even some non-economic items. So those, we call those things over on the right-hand side of the equal sign, normalized earnings. Think of normalized earnings as the amount of earnings that results from regular old normal business operations. Now, here, let me just quickly go back here. Look at that middle oval point there. Is kind of a light red. Adjustments. So let's go ahead and talk about, what are some of these adjustments? Tax-motivated expenses, above market compensation for family members. This is a really important one. In fact, the reading has a big old paragraph about this extra compensation. Of course, J.R. Ewing and Bobby Ewing, they got paid a lot of money, and then they hired some family members to do just other stuff, and they paid them a ton of money. So that's above market compensation. Loans taken out by owners. Of course, sometimes these loans are taken out from outside entities, but they're also taken out from the business itself, and so that's a really big concern. Excessively high owner compensation levels. There was never any talk in Ewing Oil about how much Miss Ellie, J.R. and Bobby's mother, made, but she went wherever she wanted, and she never had her credit card with her, and so she could spend whatever she wanted to. So clearly she was a high owner compensation because Miss Ellie was loved by everybody in the show, and she was my mother's favorite character on the show as well. Personal expenses charged to the firm. Look for things like a limousine service or a helicopter or an airplane. Also look for things like maybe country club memberships. These would have to be adjusted. Now remember, when we were talking about publicly held firms and executives excessively consuming these perks, that was a big old agency conflict. We're not really talking about that here because the owners and the shareholders and the managers and the executives, these are all the same groups of people. And of course, if JR is going to have a helicopter, he's going to call it, this is the Ewing 1 helicopter, and not pay for that out of his personal expenses. How about real estate stuff? So market rental charges, of course, remove income and depreciation expenses, adjust the lease rate to a market rate. That makes sense, especially if you have a company in which they own a couple of buildings, and those buildings are being charged rent between and among all of themselves, and somehow it flows back to the parent company. And then, of course, you have Ewing Oil. You have different family members living different places. And so that could be pretty complex, but I don't imagine it would be complex on the exam. And look at that last embedded circle point there. Value real estate separately, and that's probably an important part of it. Other adjustments, inventory, depreciation, and capitalization versus expensing. I remember being an undergraduate student and thinking, why wouldn't you want to capitalize every expense no matter what it was, so that you could get down to an taxable income of $0? Don't you want to minimize taxes so we could take off this huge expense this year, then we pay no taxes this year? But of course, the government and these accounting bodies, they want you to spread it out over time, but they give you some choices. Of course, they give you choices. So that's an important one there, that third circle point, capitalizing versus expensing. How about issues in cash flow estimation as they relate to those adjustments from the previous page? So it's a really important decision to be made by the financial analyst to determine whether or not we're valuing a controlling interest or a non-controlling interest. And to do that, we're probably going to have scenario analyses, one for controlling and one for non-controlling, so we can change all of those cells inside of an Excel spreadsheet under different scenarios. And we'll probably have different scenarios for different stages in the life cycle as well. Of course, a firm that is approaching an IPO, that's a firm that's growing like this, right? That's a good thing, as opposed to a firm that's ready to declare bankruptcy. That's a firm that's going like that. So you have opposite stages of that life cycle. And then inside of that, there are all sorts of management biases, including the value of goodwill. I mean, Ewing Oil took over lots and lots of other oil companies over the course of its 8 or 10 years. So there was tons of goodwill on its financial statements. And then look over on that right one here. Let me just remind you, we talked at length about the importance of capital structure. So make sure that you use free cash flow to the firm when that right-hand side of the balance sheet is going to go from, this to this, or this to this, or whatever that change is. Always be sensitive to capital structure. Isn't that what Modigliani and Miller taught us back in 1958? All right, let's go ahead and start with this income approach method. Let's go ahead and recap determining free cash flow to the firm in the orange box and free cash flow to equity down in that blue box. And so this should be super familiar, especially for those of you who just watched the series of recordings on those 3 previous readings. But this is what I want you to do right now. You ready for this? I want you to pause the video and I want you to go back to the slide deck that I had for the free cash flow reading. You don't have to listen to me or watch me over and over again, but look at the slide deck. I think it was somewhere around slide 16 or 18, somewhere in there. There was a series of slides where we started with a couple of different things like EBIT or net income, and then we had to add or subtract. And I told you back then how important that was, and I told you it was probably going to repeat itself at some point. So go ahead and pause, find that slide deck, and just look at it for just 2 or 3 minutes, and then come back. And then you'll be caught up to speed as we go through the methods under the income approach. So let's go ahead and start with the free cash flow method. All we're going to do is take the present value of the expected future cash flows during some time period. Now remember, in the dividend growth model, we were assuming like supernormal growth rate for 5 or 6 years. And then we did this kind of a very similar thing when we did free cash flows. But then when we did residual income, we just kind of estimated residual income for 3 or 4 years. But all 3 of those methods relied on that middle circle point, present value of terminal value. So we're going to take present value of some cash flows plus the present value of terminal value, and that's going to give us the value of the firm. And here are 2 formulas and equations that you should clearly remember from a previous reading. The value of the firm is a present value of a growing perpetuity in both cases. But notice we've got free cash flow to the firm in the numerator on the top equation, free cash flow to equity in the bottom equation. Let me remind you again for the 100th time, you need to make certain that that is a subscript 1 there. So make sure you don't put in 0, whatever free cash flow is today. Make sure you enter free cash flow to the firm or equity in time period 1. And then, of course, we're just going to divide that by either the weighted average cost of capital, which is the total interest rate on the right-hand side of the balance sheet, which makes sense, right? Free cash flow to the firm, right? The entire firm. Think of it as the entire right-hand side of the balance sheet. But then in the bottom equation, free cash flow to equity, we're only going to divide that by the required return on equity. We're trying to value the equity there in the bottom, value the firm up there on the top. So let's go ahead and take a look at 2 simple examples. The first one here is super simple. Free cash flow to the firm currently is $30 million. Grow at 3.5%. So listen, you know this. In these, the Institute is going to say, look, the numerator we're going to give you the possible answer. Choice A is just 30 in the numerator divided by 12 minus 3.5. You know that's going to be one of those potential incorrect answers. So make sure you multiply that by 1 plus the growth rate of 3.5%. Weighted average cost of capital is what's given? 12% minus the 3. So you get, what is that? Can I round up to $360 some million? And the value of the firm is that, and then we can take out that $60 million in debt. So what does that get us? Somewhere around $305 million. So make sure when you get to this question, because look at the LOS, it does tell you to calculate. So you need to be prepared for this question. Make sure you answer the question, value of the firm or value of the equity. So what did I say? Answer choice A. If the question is calculate the value of the firm, answer choice A will be with 30 in the numerator. Answer choice B will be 305, value of the equity, and then the correct answer, C, will be 365. Now let's go ahead and look at an example that's pretty much taken right out of a super example in the reading. This is a little bit more complex, and this is where we're going to have to use terminal value. So back here in this one, we don't really have to use terminal value. I mean, the value today is really the terminal value, right? Mathematically. But here, notice what we're saying. We have sales today of 20 million, net profit margin of 15%. And then we're given a bunch of stuff here below that sales figure that's going to allow us to go ahead and compute free cash flow so that we can compute the value of the firm. So I'll go ahead and toggle back and forth here just so you can see the answer. So let's go ahead through and work through this. Determine the value of the firm. All right, you ready for this? So sales, we got 20 million, right? And we know that they're going to grow by, look at the growth rate for the next 2 years, 8%. Whoops, I went the wrong way there. So 1.08, 1.08. So there's the sales for year 0, 1, and 2. Multiply each one of those by 15%. We were given that up at the top, net profit margin. So we get net income of 15%. And then what we're going to do is we're going to go ahead and take these percentages that are given to us in the question stem and just multiply them as a percent of sales, much like we did net income. So depreciation 10%, after-tax interest expense 1 3/4%, fixed capital investments 5%, and working capital investment 5.5%. Now, some of you might look at this and say, well, this is a little bit unusual, but this is exactly how the authors of this reading attack this problem, by making an assumption, and these are reasonable assumptions that don't really need to be explained in a vignette. These are reasonable assumptions that what the firm does is make decisions based on its revenues, and they either increase or decrease things like depreciation or a bond issue or working capital investments. And so those percentages there, since it's given to you in the reading, it's probably going to be given to you in this context as well. So you can pause the video if you want and go ahead and make sure that the math is correct. So we get those free cash flows to the firm, 325, 351, and 379. All right, so our first task is to, let's just remind ourselves, look, growth rate, look at the bottom of the table, growth rate for the next 2 years, 8%, and then the long-term sustainable constant growth rate falls back to a more normal 3%. Let me just remind you, I've said this to you before, this is a great exam question for lots and lots of LOSs. Why is that growth rate going to be 8% for just 2 years? Why is it going to fall back? And many of these readings give multiple answers, but the clear and most important reason is because of competition. When the competitors see us growing at 8%, they're going to say, hey, we want some of that. All right, so let's go ahead and compute terminal value there for time period 2. Notice there's a subscript 2. We're going to take the 379, which is the free cash flow in year 2, and then add the present value of everything past that, which turns out to be 4337. So what's the value of this firm? We're going to take, now we're ignoring what happens today, right? The 325, throw that right out. We're going to take the present value of the 351. So notice Notice we have 351 divided by 1.15, and then we're going to take the 379 plus the terminal value of that 4337 that we just computed, and we're going to divide that by 1.15 raised to the second power. You might remember that sometimes when we get to this point in a time value of money problem, I show you the steps using the cash flow buttons, but I didn't here just because it's only 2 steps. So it's probably just as easy to do it this way as it is to use your CF button. So there we get the value of the firm, 38. And I guess we could go back over here. Look in the middle there, par value of the debt of 5 million. So we could take out that 5 million and get 33 million for the value of the equity. So be prepared for, are you ready for this? A simple problem where, I mean, essentially that's really just the Myron Gordon growth model, right? A simple problem there versus a more complex problem where we have to estimate from cash flows like we did in this example. Be prepared for both of them. All right, how about if we move on to the next method, residual income, and this reading also refers to this as excess earnings. I don't think I mentioned that term in the residual income reading, but remember how we defined residual income. It's the net income or the earnings per share minus, which includes all the explicit costs, right? Minus some of the implicit costs, which include an opportunity cost. And so here's exactly the same thing. It's just a little bit of a different context. So we take normalized earnings, subtract out the return on working capital. Remember what I always tell you about this. Just think of that as the return on short-term investments, return on working capital. And you can always think of that as an opportunity cost if you want to. Although I'm not sure that adds a whole lot of value to our understanding. And then subtract out the return on fixed assets, which of course includes things like the required return on equity. And that gets us residual income. So what we're going to do here is we're going to compute the value of the intangible assets, right? So there's our residual income. That's in time period 0. So we're going to multiply that by 1 plus G. And then we have to subtract the return on the intangible assets minus the growth rate, and that's really just our Myron Gordon growth model there. And then the value of the firm, we need to make those adjustments there at the bottom. So let's go ahead and work through a quick example here. So we're given working capital 45, fixed assets of 180. So you could almost think of the value of this firm as, what's 180 and 45? What does that get us up to? 225. So that's some kind of like an accounting estimate of value. Maybe it's book value, maybe it's market value. But, as you're going through this, you kind of get a sense that, okay, 225 is some number. But then normalized earnings, current normalized earnings, that's 21,000. So what we want to do is we want to take the present value of those normalized earnings. And notice we're given a whole bunch of returns there. Working capital return, fixed asset return, return on intangible assets, and then a growth rate. So we'll just go ahead and use that equation from the previous page, which we've put for you right there in the middle. But let's first start with the return on working capital. So we were given that 3% times the 45. Return on fixed assets, we were given the 8% times the 180. So that gets us the 1350 and the 1440. And all we're going to do is subtract those two from our normalized earnings, and we get that 5,400. Put that in the numerator, but that's current, right? So multiply it by the growth rate. Were we given that growth rate? Yeah, there it is, 2.5%. Multiply that by 1.025, subtract it by the 18% minus the 0.25, and that gets us 35,710. So we add working capital, we had the fixed asset. So there's the 225 that I was talking about earlier, just kind of a general idea about, the value of the firm based on its assets. And then we're going to add those intangible assets, those normalized earnings, right? Converting that to residual income. So there we get 267.10. Now, of course, back here in this problem, we were given 18%, right? And back here, we were given, what we were given, 12% and 15%. So we have to ask ourselves the question, what does this LOS tell us? Explain factors that require adjustments when estimating the discount rate, right? You know, in the old days, and when I mean old days, I mean like 100 years ago, when time value of money was in its infancy, you know, people used to say things like, oh, well, let's just use the inflation rate to discount. And then they thought, well, that's a good starting point. What about risk? And so we need to figure out what kind of a discount rate and what kind of adjustments that we want to impose on that discount rate. Because look, we could go back here and we could do the numerator right there, the 5,400 times the 1.025. I mean, we could live with that as residual income and as it grows in perpetuity. But then what if we put down in the denominator 5% minus the 2.5%? I mean, we get a totally different number for value. So we need to make certain that required return, whatever we're calling it in the denominator, is based on things like size, right? Of course, size effect can increase the discount rate. You know, it's well known that smaller firms have a greater size effect. So if smaller firms ought to have a higher discount rate. Of course, we need to look on the right-hand side of the balance sheet. If we have tons of debt, we have tons of financial risk, and we probably have tons of operating risk as well. So that's going to be an increased cost of debt, which probably is going to increase the discount rate. Here's a really good concept. Remember back in Ewing Oil. So Ewing Oil is a private company. Ewing Oil was taking over other private oil companies. So what interest rate do you use? What discount rate do you use? Ewing Oil's discount rate to value that company over there? Do you use that company's over there discount rate? Or do you use something else? Well, what does this reading tell us? It must be consistent with the riskiness associated with those cash flows, not necessarily the acquirer's cost of capital. I mean, we're tempted to say, okay, if we take over that other company, I mean, J.R. Ewing and Bobby Ewing, they're saying, if we take over that other company, we're super smart. We're going to manage that company better. Our weighted average cost of capital is low because we're really smart and we have no risk, 6 or 7%. So we're going to value those cash flows over there. But maybe that's a different quality of oil. I'm making this stuff up because I'm not an oil person, right? But I know there are grades of oil. So when they get that oil out of the ground, maybe it's sludge. I made that word up too. Maybe it's sludge, or maybe it's even more pure than the Ewing oil. So you see that we've got to be super careful, consistent with cash flows. How about lower availability of information and managers who are inexperienced at forecasting? Okay, we call that projection risk. And then lifestyle, we've talked about that multiple times. So you should be saying to yourself, all right, Jim, we've studied the capital asset pricing model, not only since the beginning of level 1, but we learned that all the way back, not even since our first undergraduate days, but we learned that way back in high school. Or maybe we learned it way back in kindergarten. I promise you that when my children were in kindergarten, I used the words capital asset pricing model to them. Of course, they didn't understand it at all. They still don't understand it. But anyway, so capital asset pricing model. Of course, this is a great starting place. However, in order for us to use this capital asset pricing model, we need to be able to come up with a beta. And we need to be able to come up with a market risk premium. And with a private firm, we don't have readily accessible market data to come up with those input variables. So that's why we have that term generally inappropriate. However, what we can do, we can go back to CAPM, call it an expanded capital asset pricing model, and we can add some variables. Of course, a small stock premium, a company-specific risk premium, and then we could add some other things there if we wanted to, but the reading pretty much stops there. And then whenever I teach my students in a class like an investments class or maybe a financial institutions class, I always tell them about capital asset pricing model and the arbitrage pricing theory. We do that stuff. And then I say, you know what? Let's forget about those things. Let's go ahead and start at the bottom with a building block like we did in kindergarten. And let's get another building block and put it on top, and another one, another one, another one. And let's see if we can't make sense of those building blocks. This is the build-up approach. So we start with the risk-free rate, and then we just add these premiums. So an equity risk premium, a small stock premium, a company, just like we did for capital asset pricing model, an industry risk premium, and we could make something else up, GEMS premium or a commodity risk premium. Of course, commodity would be important. An oil premium would be important for Ewing Oil, right? I mean, this is all this company does, is it digs oil out of the ground and then sells it. Look at that last arrow point, used when guideline public companies are unavailable. All right, so let's take a look just at a super quick example here. In the table, we give you some pieces of information, and then all we have to do is input those to the CAPM, the expanded CAPM, and the build-up approach. The LOS asks us to compare the models. And so we're comparing them based on things like beta, right? Capital asset pricing model relies on systematic risk, and it relies on that beta to capture all the systematic risk for Ewing Oil. Now, that's probably not going to be available because Ewing Oil is a privately held company. But what we can do is we can estimate that beta based on other kinds of factors. We did this in a previous recording. And then we can just add some things there. So the question then becomes, we compare them. All right, so we're deciding about different risks and different premiums. And then, of course, we're going to get different numbers here. I'm not sure if the LOS asks us to pick one that is most appropriate. That sounds like a great question to me, but I don't think that is part of the LOS. All right, how about the market-based approach? All right, observe multiples. Of course, you knew this was coming, right? We spent so much time talking about price to earnings, price to sales, price to cash flow. So look at the steps. Identify a group of comparable public companies, pricing models, adjust those pricing models for relative risk and growth prospects. So look at that bottom orange block. Adjust pricing multiples for relative risk. So that's kind of like the build-up approach right there. We're adjusting these, we're building the blocks for certain risk factors. Couple of advantages here. There are many companies that have substantial information that's available. So, I mean, of course, the problem is just finding those. And that's the disadvantage, comparability and subjectivity issues. Yes. So let's look at just a quick example here. Market value of debt, normalized earnings, and a bunch of other stuff here. Now let's introduce a couple of concepts here. The price multiple will be deflated by 12% due to increased risk of the private firm. So here is one of those adjustments. For a strategic buyer, a control premium of 13% from the previous transactions is added. All right, so for a non-strategic buyer, there's no control premium, but we need to consider that price multiple deflation. And so let's go ahead and come up with some kind of an estimate for the value of the equity. So let's look at two scenarios, in the orange box for a strategic buyer, in the blue box for a non-strategic buyer. So risk adjustment, we have that 6 times 88%. So let's just go back real quickly here. So there's the average multiple of 6%, market value of invested capital over EBITDA, so that's 6. So what we're going to do is we're going to multiply that by 1 minus that discount for increased risk. So we get 88% of 6. That gets us down to 5.3. But since we're a control premium of 13%, we need to multiply that, and we get back to the 6. We get back to the 6 multiple. Multiply that by the normalized earnings, right? 50,400. We get 302 something, and we take out, let's see, we're given market value of debt of 12,240. So there's value of the equity of $290 for a strategic buyer, which includes a control premium. And this is important, of course, in the acquisition and merger gain. For a non-strategic buyer, we go through the same math, but there is no control premium that should be applied. So we do the math quickly and we get value of the equity is much less. What is that, about 40,000 less or so? Now, how about a guideline transactions method? So this utilizes pricing multiples from the sale of public companies, right? So we're going to just look over there and say, all right, there's Jim's Oil Company. That was a publicly traded company. It's about the same size, has about the same risk as Ewing Oil. So let's go ahead and collect all of Jim's data, and then let's apply it to Ewing Oil. But notice that second circle point there. Adjustments to the multiples to incorporate the difference between Jim and Ewing Oil. Now this is probably most suitable for a controlling interest, which means of course we're going to have to figure out what that control premium is. Now remember, over in the public market, I told you that the average takeover premium is about 50%. Not so true in the private market. And that's why we had an example. What was that last one? 13 or 15%. All right, so we need to look at some variables that contribute to what kind of a model we're going to select. So is the transaction strategic or non-strategic? What about industry conditions? You know, you got this industry, the oil industry, that is made up of, oh man, who knows how many firms are in the oil industry, but we need to make certain that when we attach this adjustment to Ewing Oil, that we're attaching an adjustment that reflects the risk, the relative risk of Ewing Oil too. Now remember, in 1980, this was, you know, Exxon and Mobil and British Petroleum. Now remember, when public companies merge or take over or acquire other companies, they can pay in cash or they can pay in shares of their own stock. And the target shareholders, they can see what the value of that acquirer firm's stock is. They just look on the floor of the New York Stock Exchange. But now, boy, when you have two private firms that are merging, or one is taking over another firm and is paid in stock, boy, that's completely different ball of wax. And then reasonableness, I use that word pretty regularly, right? How about prior transaction method? This is based on the actual price from transaction of shares of the subject company. So this is probably most relevant when there is a minority equity interest. Notice the advantage, provides the most meaningful value, but it tends to be unreliable because there probably are not lots and lots of these transactions. So if you have these prior transactions, that's beautiful. Then use this method. If you don't, well, then there's going to be some possibility of error. Now, how about this final one, the asset-based approach? This reading also calls it a cost approach. Look at that middle teardrop point. Conceptually, it's the weakest approach, rarely used for valuing going concerns. But all we're doing is looking at the balance sheet. This is what I was saying earlier. We're taking a look at the fair value of the assets and the fair value of the liabilities, subtracting those two, and we're getting the value of the equity. This is most appropriate for, you know, financial service firms, very small businesses with limited intangible assets, maybe holding companies and holding investment companies, and maybe resource companies. Let's move on to this concept of a discount for a lack of control, right? If we take over another company, we may be able to control that company, or we may have a minority interest and we may not be able to control this company. Or if we're someone like Lucy Ewing, who was Bobby and JR's niece, I think she owned maybe 5 or 10% of the company. She had absolutely no interest in running the company, nor would JR or Bobby Ewing ever consult her about it. And so there has to be some kind of a discount for the lack of control. And there's a pretty standard formula for a discount, all we're going to do is take the difference between 1 and the reciprocal of 1 of the control premium, 1 plus the control premium. Now, I think the important part of this LOS is explain, right? So this discount is higher when a private company has not paid dividends and it has no chance of going public. So that's probably important to remember. That's why we put that in the grade box. Discount is lower when it's seeking an IPO and it is a strategic sale. So that's important. I would know those 2 gray boxes. Here's super simple math here, right? So all we're going to do is control premium results in a discount of 13%. And much like there's a discount for loss of control, there's one for, lack of control, there's one for lack of marketability. This shows the absence of marketability, right? Remember now, Ewing Oil is owned by 8 or 10 people. Lots and lots of other companies and individuals wanted to take over that because their assets were of tremendous value, but JR and Bobby were not interested in selling, and most family members were not interested in selling over time. However, in this absence of marketability, there has to be a discount, and this is probably when there is a non-controlling interest. And so this slide is probably one that is super important here. Factors that increase this discount for lack of marketability, restriction on sales. Oh boy, this was true with Ewing Oil. Restrictions on transferability. This was probably true as well. Higher risk. Yeah, probably true. Greater uncertainty, no doubt about that one. Concentration of ownership. So all of those factors are probably apply to Ewing Oil. Factors that decrease: high prospects for liquidity, payment of dividends, large pool of potential buyers, and the duration of the asset. I guess you could argue that the oil wells have long durations, but anyway, I would remember the purple arrow and the orange arrow. I would remember those because these are really, really cool ways that the Institute can just throw one of these sentences at you in the middle of a vignette and say, something, 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 and then this company pays dividends, and then all the way at the bottom, tell me about this discount for lack of marketability, and you're thinking, okay, did I read anything about there? And somewhere in there, there'll be something about dividends, and you'll say, oh yeah, that was right. That's why I remember when I always took exams, no matter what exams were there, I always had my pencil. And I did a lot of circling on the question stem just to highlight stuff. I don't know if it helped me or not. All right, how about valuing an equity interest? And so based on what we just talked about in those previous slides, all we're going to do is take the equity interest and multiply that by a discount. One is a control discount and one is a marketability discount. And so, boy, look at those simple example here. We've got a 15% and an 11%. So all we're doing is we're going to say something like our discount is, what is that, 85% times 89, and we do all that and we get about 25% of a total discount. Boy, I'd love to be able to pick out the two most important LOSs here. I said this before, public and private company comparison. That's a good one. But what is that? The fourth one down, explain income market and asset-based approaches, and then skip down to calculate the value using free cash flow, capitalized cash flow, and the excess earnings. I think those are probably the super important ones. And then, of course, trying to figure out what kind of a discount rate to use.